So thanks a lot to all of you for taking the time. So first, a bit of housekeeping rules. The event will be recorded and posted online on our website, cpweb.org, sorry. So I hope that's fine for all of you. So remember that you are muted by default. So please unmute yourself whenever the floor is given to you. Unmute yourself back so that we keep a bit of order. And whenever you want to intervene, there's a raise hand option in the reactions tab that you will see in the menu at the bottom of your screen. So it would be nice if you can use that. Even more for the second part of the event, where we will try to make a bit more dynamic setting and open the floor for Q&As to the rest of the audience. So as those of you who already joined us for the first roundtable last week on corporate income taxes, we are launching CPs, hosting this series of events against the backdrop of what we believe is an urgent need of reform of tax expenditure systems. Why is that the case? Well, tax expenditures are a valid policy instrument that are used widely to pursue different goals. There are many cases of effective tax expenditures implemented across the world. The earned income tax credit in the US is one of the largest tax expenditures and has been proven to be effective. But also, these tax expenditure provisions often present several issues. One is the fiscal cost. The second one is that they are sometimes opaque. There's a lack of transparency. There's limited available information on tax expenditure. And very often they're ineffective in reaching their stated goals. And they also trigger undesired negative effects or externalities. So let me give you a bit more of a grasp of what I have in mind regarding these four features. So a significant amount of government funding worldwide is channeled through tax breaks, tax relief, tax subsidies, or tax expenditures in the form of exemptions, deductions, tax credits, deferrals. Just to give you a concrete example or figure, on average, tax expenditure over GDP is around 4.5 percentage points in the EU. That's the average for EU member states, and can be as high as 13% in the Netherlands, more than 12% in Finland, and more than 10% in Czechia. So the problem is that, as I said before, there's a strict opacity in the field. So these figures should be taken cautiously. And the lack of transparency comes from mainly two dimensions. One is a lack of adequate tax expenditure information at the national level. So again, in the EU, there are at least 3 member states, Cyprus, Luxembourg, and Malta, that do not report the revenue forgone through tax expenditures at all. And at least another 5, Czechia, Hungary, Portugal, Romania, and Slovenia, where the information provided is very limited. So in any case, these 8 countries are breaching the Council Directive of 2011 on requirements for budgetary frameworks of the member states, where, and I'm quoting here, member states shall publish detailed information on the impact of tax expenditures on revenues. So there are a few worth mentioning initiatives by the OECD, for instance, on R&D tax incentives and fossil fuel subsidies, one that we will be talking about a lot today, regarding cross-country data. But there is also a striking lack of cross-country comparable data at the global scale, and also covering all tax bases and all policy objectives. So we, with the colleagues of the German Development Institute, are working on a project to put together the global tax expenditure database, which will try to fill in this gap. So stay tuned for that. That's coming in the next month. And as a result of this lack of transparency, what happens is that very often these provisions, these tax expenditure provisions, are not subject to sound analysis and debate. So this lack of attention and evaluation is part of what we think is crucial in the discussion about reforming tax expenditure systems worldwide, and in particular in the EU. So in this context is that we decided to launch this series of events. And today we will focus on consumption tax expenditures. So tax expenditures granted in the context of consumption taxes. We have a great lineup. Paul Tang is member of the European Parliament and the chair of the Subcommittee on Tax Matters. So Paul, thanks a lot for joining. And let me give you the floor to you to open the discussion. We know that the use of tax expenditure remains widespread across EU member states. I gave a few figures here, but that's the case in the rest of the member states. So what we know is that these provisions are a valid policy instrument. Governments pursue different policy objectives like creating employment, or now in the context of COVID-19, support households or businesses, but they are also controversial since there is a significant lack of transparency, and hence they are prone to lobbying, for instance, and interest groups. So can you please give us an overview of what's, in your perspective, the use of tax expenditures in the EU?
Well, let me try to do that. At least let me try. I'm very happy to have this discussion. I think it's part of a broader discussion that we will have and will need to have, given that we are in a situation where, in a situation of crisis, the pandemic, but which also leads to a huge imbalance in the public sector. High revenues to support people and companies on the one hand, and low income on the other hand. And once we have some sort of control over the pandemic, and let's hope that's going to be soon, we're going to again face the situation of bringing the two more in balance. I don't think that, like in 2011, we will step on the brake, saying we'll go back to a policy of austerity and reforms. But this time we will also look as ways of raising revenues. And I think that's, for example, tackling tax avoidance is one of the issues that will be high on the agenda. But looking at tax expenditures is also one of the issues. It sometimes overlooks because it's indeed not transparent and complex, but I think it is important. Because there are many holes and gaps in the tax base that comes from these tax expenditure, and can you find a way to rationalize that? I'm a member of European Parliament. I've also been a member of the national parliaments, and also made me realize that sometimes making the tax system simpler, broadening the tax base, seems like a very good idea, and in fact is a very good idea, and at the same time it's not simple to realize. So simplification itself is not simple, because keep that in mind, like you said, what you call lobbying is also a democratic process, right? And this is the way our democracy works. And I always find it very difficult sometimes. I find it in that situation very difficult to come up with a simplification or broadening of the tax base, because it has significant effects on the income distributions in general. And you want to, so this is where members from national parliaments are usually in, and so it's more than just transparency. We also need to think of ways for reform, that indeed you can have an encompassing reform for broadening the tax base and decreasing some of the tax expenditure. But it starts definitely with transparency. What is the aim of the tax expenditure? What is the effect of the tax expenditure? And I think this is very very welcome. And I would like to make a different, and like would like to say that there are also tax expenditures that have an impact at European level, and this is where you would hope that we have a more European debate on tax expenditures, right? And what comes to mind is, of course, they have tax expenditure with an environmental impact. It's very clear that we have subsidies on fossil fuel, And I remember from my own countries, the gasoline into agricultural equipment has a reduced rate, right? And it makes some sense when you start to think about it. But is that reduced rate in line with our idea of becoming carbon neutral in 2050? And this is where, of course, the Energy Tax Directive may help. And I think it should push in this direction, at least to the abolishment of fossil fuel subsidy, because I don't see how you can rationalize making a transition to a carbon neutral economy and at the same time have subsidies for fossil fuels. But then again, think about the distributional consequences of that. That's always an issue. Even more important, I think, is that we need to go to a system to make the system of tradable emission rights work. And to make it work, we need a carbon border adjustment mechanism. This has been in theory in our minds for a long time, but now we have to put it into practice. And I think that's crucial because there are a lot of industries, intensive industries on the carbon leakage list that indeed should also make the transition. And it's crucial to make that these industries make the transition to carbon neutrality. Otherwise, it doesn't make. It won't happen. We won't reach the aims of the Paris Agreement. And some may be more than easy than others. When I looked at the carbon leakage list, I saw, of course, the steel industry. I have some feedback sound. I'm not sure if someone is. Okay, sorry. Of course, there's the carbon leakage. It's the steel industry, but I also found that there were freeze potatoes on the carbon leakage list, which I sort of so that is that is crucial. But let's also think. What I find surprising also is one issue I would like to raise, and I think it will be addressed later on. I'm very curious to hear, very interested to hear what always has surprised me is that the VAT is not including financial services. I think was an issue we should also address. I know it will come up later. I'm just flagging the issue here. I think it makes sense. To look at some financial services to bring under the VAT under the VAT rate. So even at the European level, we need to consider and reconsider what we can do to raise revenue on sectors that are now exempted. And I think that has been helped enormously to the rise of the financial sector. The fact that they were not VAT, they not fall under the VAT. Then again, I'm just going to have a brief kickoff. I'm happy to have the discussion later on. Let me say that at the same time, we need, and that's bring me back to my original point, that we need we need to have a good interaction between the European level and the national level. And I can't say I have made up my mind there. On the one hand, you see that, for example, the discussion on the tampon tax in the UK has got a lot of public and political momentum. And so we need to consider at the European level whether the system, the VAT is with the exemption, with the zero rate, the reduced rate or normal rate is how we would like it. And I think that discussion shows that we need to look into that as well. And at the same time, but this also comes from my experience as member of the national parliament, it's always very helpful that there were European rules for this, because it didn't give you much leeway and you could resist pressure. So in that sense, it was helpful. An economist would say, and I'm sorry, I'm a big economist by training, it's a commitment device. It helps also national politicians. And this is the interesting interplay that I see between the national level and at the European level. So don't discard let's say the discussion we have seen in the UK on the temple tax, that's just lobbying. No, it's not. It may show real concerns of people, and we need to have that on board at the European level. On the other hand, the European regulation and directives may very much help also as a commitment device for national parliamentarians to withstand the lobbies, and that may also help to make sure that once you have made changes in tax expenditures, it also help to withstand the pressure to make gaps and holes and to erode the tax base and so on. So that is something I also would like to have in the discussion. What is the interplay between national and European level? Because that's sometimes, for me, it's still a bit complex, and I haven't really made up my mind on what is the best way to go forward. But to sum up, I'm very happy to have this discussion on tax expenditure. I think it will be crucial in the years to come because we need to raise revenue in a fair way. It starts with transparency, but we need to definitely look at the spillover effects at the European economy as a whole. We are partners in that, and further look into the interplay of national and European policy making. Thank you.
Thanks a lot, Paul. Very interesting. And I have to be honest, that the idea of this series within the series and focusing on Europe at the beginning actually comes also from that questioning of how this vertical dynamic between national governments, policymakers, parliaments, and European institutions work when it comes to tax policy in general, but the tax expenditure policy also in particular. And it sounds like a complex topic indeed, because there are many players. It's a very particular setting, the one in Europe. So maybe as chair of the subcommittee with the European Parliament leading with these topics, with tax matters, you can tell us a bit how your strategy goes in terms of making sure the Parliament's views on these issues are heard, and that you can play an active role, right, in this dynamic with national governments.
Yeah, thank you for that question. I'm happy to. You see, the European Parliament is in a special position. We are better informed than national parliaments, but we have less competence than the national parliament. So this is what the situation we're in. But we are dedicated to tax issues, and are, like I said, better informed, better able to also to see the trade-off across countries. What my long-run aim is also for the subcommittee on tax matters is to be a hub in the European discussion. My experience, like I said, I've been a member of national parliament, but my experience with discussions with members from national parliament, be it from the Bundestag or the Assemblée Nationale or whatever, is that they have a keen interest in these topics, but are not fully on top of it. And I would very much like to see that we are a hub in the European discussion, that we bring together political and policy discussions, and share this also with national parliaments. For example, some time ago, I had a discussion with members from the Bundestag discussing the OECD BEPS discussions. And you see that they are aware, but they are not in full detail aware what's going on. And at the same time, they can play a crucial role in that. So this is what I very much hope for. And I think there's a good situation in the sense that, of course, we have the European Commission that is taking the lead in many of the issues. We have said Pierre Moscovici was active. I expect Paolo Gentiloni to be active. We now have the European Parliament that has regular hearings and meetings diving into many of the topics that we need to dive into. And we get the tax observatory now that will be led by Gabriel Zuckman. So we finally get the infrastructure for the discussion on politics and policies that we need to have, and I think that will be very welcome. But it can't remain in Brussels. That's the point I'm trying to make. We try to bring it to national parliament, and as a point, we will have, for example, and I think that's unique in the way the European Parliament works. We have a common meeting with the Portuguese Committee on tax matters in March. And that's for us the first time, and in a sense an experiment, but it shows the way I would very much like to go, to be in close touch with national parliaments and to, in that sense, to Europeanize the debate. Like I said, like with the interaction that I just mentioned when I was in a national parliament, where the European rules are at the same time a commitment device as well as an annoying because binding constraint. Well, this is an interesting discussion you should have. And I couldn't have that at that point as a member of national parliament. As for me, there was no way to reach out to the European level or to other members of national parliaments in different countries. So I would very much like to break through this situation. And my experience is also that because the European Parliament is better informed, we can indeed can raise public pressure and political pressure also on the capitals and on the ministers of finance, and that will certainly be part of our job.
Okay, thanks a lot. Very interesting. I will come back certainly to the political economy and these dynamics later on. So let me move to Luisa Dressler, who is economist with the Tax Policy and Statistics Division with the OECD. So Luisa, in Europe, most of tax expenditures in the context of fossil fuel subsidies are channeled through reduced rates or full exemptions on energy and carbon taxes. And the OECD, as with the BEPS initiative, has been working quite intensively on these topics as well. So can you give us a bit of a broad picture of this issue from the OECD perspective?
So hi, Augustin. Hi, everyone. Thanks for the invitation to participate in the event. It's a timely topic. And as you said, it's one of our core business to look at tax expenditures in the context of energy and fossil fuel consumption. So we're really glad to contribute to the discussion today. Don't have the same level as the BEPS project, maybe in terms of reach out, but I mean, I think I can give following on what Paul said is like giving a little bit of a framework on what he already meant. He already mentioned most of the key issues I'm going to talk about, but I think I can give a little bit of a framework and some of the empirics, because we observe a lot of countries and what countries do actually. So in Europe, so I think I'll do that. So just to get started from the same page, and I hope I don't repeat too much what everyone knows already. Fossil fuel subsidies in the EU take, to a large extent, the form of reduced tax rates and tax exemptions on energy use. There's, of course, some producer subsidies still going to coal and all that, but today we talk about consumption taxes. So, and it's the bulk of the subsidies that go into reduced energy taxes and tax exemptions on fossil fuel use and on carbon pricing more general. And when I mention energy taxation in line with carbon pricing, this is for one specific reason. Taxes on fuel use, for example, think of excise taxes on gasoline, excise taxes on coal, excise taxes on natural gas. They typically set a tax rate per physical unit or per unit of energy, so in joule, but they also translate into a carbon pricing signal, precisely an effective tax rate based on the carbon content of the fuel. We all know that burning coal emits CO2, so their local air pollution, it's not only CO2, there's a lot of other environmental externalities linked to burning fossil fuels. And so environmentally related taxation and energy taxes are part of that, can internalize these social costs from burning fuels and internalize these social costs into the price of fuel and send a price signal. So bottom line, energy taxes translate into effective carbon taxes. And so tax expenditures on energy taxes translate into a reduced carbon pricing signal for those energy users that benefit from energy tax expenditures. And we at the OECD Center for Tax Policy and Administration, we have a long-standing tradition to really collect and analyze these energy tax and carbon pricing trends. And we do this for OECD, G20 countries and more. And what we do, and I share a quick look at that, we start from the energy use base here or the CO2 emission base in a country, and then we look per sector, what is the effective tax rate on gigajoule on carbon emissions. And then we have a summary measure in a sense. We bring together energy taxes, carbon taxes, and then emission trading systems if we want to, and bring this together. And this our taxing energy use and effective carbon rates indicator. And let me just, because I know it's a bit difficult to grasp just explaining it, let me just show you one picture. This is the effective tax rate on CO2 emissions from energy use in the EU 23. So these are the countries that are both EU countries and OECD countries. And so this is one of the profiles we produce. So on the basis, you see the CO2 emissions from energy use, in these countries, we have different sectors: road sector, industry sector, residential and commercial, and electricity sector. And then you see the different taxes, the effective tax rates brought down to the CO2 content of the fuel. So you see in diesel and gasoline, we have a lot of fuel excise. That's the excise tax that we pay on the pump. And then you have some explicit carbon taxes. And in this picture, I don't have the emission trading system. It's just to show you, this is what we are collecting for all 40 and more countries in the OECD, the G20, and beyond. So this gives you a quite precise picture on effective tax rates on energy use and on carbon emissions. And I'll be very happy to share a little bit of the experience, because we can see then what are the reduced rates, what are the tax exemptions that are around, and where can we focus reform on if we want to do a reform of these tax expenditures. But before I go back to this in a minute, very relatedly to the topic is other colleagues in the OECD, they work on the fossil fuel support inventory, which is of course very related, takes a different angle from our taxing energy use database. They look at not at effective tax rates, they look at revenues, revenue for gun, and so on. And they don't look only on consumption taxes, they look at consumption taxes, they look at production, they look at the extraction of fossil fuels and go to direct transfers, et cetera, et cetera. And this is the OECD fossil fuel support inventory. So that's a very interesting work. And I can put the links to these databases in the chat afterwards. So both of these work streams are updated regularly, databases are around, publications are around, so happy to share that. But to go back to the topic, I think it's very timely to talk about this because, and Paul mentioned this already, we have two crises. No, we are navigating through the COVID crisis and the climate crisis, and the discussion on reforming energy tax expenditures is a very important one, not only because reforming tax expenditures frees up tax revenue, not foregone tax revenue, a non-negligible aspect when we think of recovery packages and stimulus measures that need to be financed somehow, but also, and Paul mentioned this as well, tax expenditures related to fossil fuels are misaligned with our commitments under the Paris Agreement. The Paris countries in the context of the Paris Agreement are committed to decarbonize our economies by the second half of the century. And then providing preferential treatment to the use of fossil fuels does not only forgo revenue, it also forgoes sending a price signal to discourage the use of these dirty fuels. What we observe in our database is that many countries in Europe and beyond, coal use is usually subject to a much lower excise tax rate than natural gas, both in gigajoule terms and in CO2 terms. Coal emits more CO2, emits more air pollution than natural gas. So this is clearly not aligned with countries' climate ambition or environmental ambition, if you think of air pollution. So this is something we observe, and also, as Paul mentioned, what are the main reasons for providing these energy tax expenditures? Then, of course, they often relate to industrial policy, perceived competitiveness concerns. In Europe, countries keep the energy taxes low, mostly in energy-intensive, trade-exposed sectors. For example, there's a reduced energy tax rate for iron and steel. Paul mentioned that already. In every country, this is of course to help industry not being overrun by cheap imports from countries with lower climate ambition. I mean, that's we know that. It's also social equity. I mean, support to low-income households. We see often that I think it's Central European countries where tax rates on natural gas are basically lower in the household sector than in industry because for these equity reasons. And also sometimes we have countries that apply reduced VAT rates on household heating for the same reasons. So one can clearly see that there's these conflicting goals. No, I mean, revenue raising, competitiveness, equity. I would say this is the standard challenge in any tax expenditure reform discussion. But then on top you have the additional dimensions: climate policy, ambition, environmental objectives, and here tax expenditures for energy are clearly misaligned with a strong climate policy ambition and the leadership that potentially the EU is aiming for. And I know there are quite interesting proposals that are floated in the policy debate on how to reform tax expenditures on energy use. So achieving a higher climate policy ambition while keeping the competitiveness concerns in mind. And I guess you're going to talk about these later, BCA taxes at the border, free trade system, emission trading systems at the border, carbon consumption taxes, all these kind of things. But I mean, these are all, like when we think about how to reform these tax expenditures for energy use, I'd like to mention another challenge, which is to evaluate them. And I think that's also, Agustin, I guess you know best, how do we, like, to measure their importance, it is important because to define priorities for reform, we need to know where the tax expenditures are. And you know best that defining a benchmark tax system against which to evaluate the incentive is practically impossible, in particular if you want to compare countries. And it's the same here in the energy tax field. Countries choose different benchmarks, so comparison across countries is quite challenging. And just looking at tax expenditure reports to define areas for reform is likely a bit tricky here, short-sighted, because of these additional climate and environmental objectives. And I just give you an example. And in Germany, large energy consumers in industry are granted a reduced tax rate for electricity. So they pay a reduced tax rate on electricity, and this is highlighted as a tax expenditure in the German expenditure report. Going to the Netherlands, they don't have a reduced rate, they have a regressive rate for electricity use. So the more you consume, the less you pay on average. This is part of the benchmark system. It's not reported, to the best of my knowledge, it's not reported. Which is, I mean, it's the country that defines the benchmark system, but you know, like, so looking at the tax expenditure report to define priorities for reform options, it's a bit tricky. And this relates back to our work. And when I showed you this profile, this taxing energy use profile, what we see as the effective tax rates, it's a full picture of how much each ton of CO2 or how much each gigajoule of fuel in the country pays in terms of tax. And this is net of expenditures. So what you can do is you can actually, without defining a benchmark tax system, you can evaluate where are the issues, where do countries differ, and where should we focus on. And then a second step, and this is what we do in another publication that's called effective carbon rates, we can apply a benchmark to these country profiles that is unrelated to the tax system. We can just take an economic value, or for example, what we use is we set a uniform carbon price at a level that is needed to reach decarbonization by the second half of the century. And then using this benchmark, which is unrelated to any country's tax system, then comparing the effective tax rate against this benchmark allows you to rate countries as well. I think Paul mentioned emission trading systems. Yes, they're of course having a strong signal on prices as well. And we collect this information as well in our effective carbon rates information. And just to summarize what we find in our reports is that across 42 OECD and G20 economies, 70% of emissions are entirely untaxed. And 97% of these energy-related emissions are not taxed at a level that is compatible with reaching decarbonization in 2050, so which is compatible with Paris Agreement. And use of emission trading system increases the share of priced emissions, but not as much as we would need to. So yeah, main takeaway, I think, for this intervention would be that from an environmental and climate policy point of view, we need to ramp up carbon prices if we want to reach our commitments under Paris Agreement. Providing energy tax expenditures lowers the ambition. It weakens the decarbonization incentives for those energy users that are granted preferential treatment. And the standard question here then is, should one start with reforming tax expenditures on energy use? Yeah, it sounds plausible in itself, but then, I mean, Paul already mentioned distributional impacts, competitiveness impacts, but also maybe it's important to identify the priorities for reform based on the effective tax rates and the profile, instead of looking at what countries define as a tax expenditure in their reports. And I think I would leave it there for the moment. Thank you.
Thanks a lot, Luisa. Very, very clear and interesting. Yeah, so just to come back a bit to what you mentioned, so clearly when it comes to international comparability and benchmarking, that's a tricky issue in the tax expenditure area in general. For me, what is just unacceptable is the lack of transparency and evaluation at the national level. And there, you know, no matter the benchmark that governments decide to implement when it comes to any tax expenditure, this is taxpayers' money a lot, and the evaluation should be done and should be sound and accurate, right? Then when it comes to the, obviously in the context of fossil fuel subsidies and carbon pricing, we're talking about the global public good. And then, you know, this international comparability is a must. We need to talk about that. And that is where I think the European institutions play an interesting role, and it's an interesting setting with respect to other countries that act as individual countries in this discussion, right? And yeah, as Paul mentioned, there are a few interesting or promising initiatives in the context of the EU, such as the Green Deal. In the context of the Green Deal, the CBA, or the Carbon Border Adjustment, the revision of the Energy Directive. But we all know that all these initiatives require a lot of coordination among member states, right? And it's a bit tricky. We have seen it in the context of the CCCTB and how tough those negotiations were in Europe. So what is, Luisa, in your opinion? So are you positive or rather pessimistic on the potential of these and other climate policies in the context of the EU regarding the decarbonization, the Paris Agreement? Do you think that we can remain positive, or this will be tricky to get to a positive outcome?
Let me just go back to the transparency. I think I don't argue against the tax expenditure reports at all. I mean, I know we need this. We need transparency, at least for those tax expenditures that are tax expenditures in the country sense, related to the country benefit. So don't take this as an argument against tax expenditure reporting at all. This is where we want to go. This is where we need to go. It's just that defining, like, it's sometimes not enough, to see where countries differentiate. We had a big discussions also. Sorry, I go to your question soon. But for example, you have different tax rates for diesel and gasoline, of course, in gigajoule and in CO2 emissions. France and Sweden, they say this is a tax expenditure. They take the gasoline rate as the benchmark and say, okay, if we provide a diesel rate that it's lower, it's a tax expenditure. And this is in the report. And then not many countries do this. So, it's just like that. We need to have this in mind when reading the numbers, I think. And to go back to your question, which was whether I'm pessimistic or optimistic maybe to say again, so the current situation is that we have tax expenditures on energy use that do not provide a necessary signal. It's a pessimistic view, I guess, because with what we have, we won't reach decarbonization in 2050, and this is because of a lot of international competitiveness concerns. That's what we already said, and I think there are different options that are discussed and that can help us reform the tax expenditures and increase our ambition up to a level that we need. The carbon border adjustment is one of them, but the discussions are ongoing, so it's difficult to evaluate the prospects of coordination at the EU level. And also, as said, I think, but I mean, there are other panel members that know better, but there are different options that are discussed: a tax, an emission trading system, a consumption charge based on carbon consumption embedded in the goods. So does unanimity apply to all of these mechanisms? I don't think so. So it all depends on the design that is going to be channeled through the proposals in June, I think, when the Green Deal is coming up. So both in the revisions of the tax expenditures will be affected both through the revisions of the energy tax directives and the carbon border adjustment mechanism. But it's difficult for me to see the design. And also, I think it's not only coordination at the EU level, it's coordination at a broader level. I mean, the trade risks are there. I mean, and I think the Commission and the Parliament, you're going to look very in detail on these risks as well. So all unclear, yes. So discussions are ongoing. But what I think is good, it's definitely a great start to the debate about international alignment mechanisms, and therefore the discussion on the carbon border adjustment mechanism is a great way to do that. And I think it's in a way exciting. I mean, there's this new US administration, there's the European Green Deal discussions, there's China who implements a national ETS. So the debate has started, and I think that's a very positive signal.
I agree. Let's stay positive then. And I agree also with Paul that probably the situation has changed compared to previous years, right? And the role of the European institutions, the European Parliament, the Committee on Tax Matters, also the European Commission, makes the possibility of this interaction and of a positive outcome, in a sense, much more higher. So let's keep it positive. So let me move to Lourdes Sanchez, who is a senior policy advisor and lead with the IISD, International Institute for Sustainable Development. Lourdes, so as the OECD, IISD has also been working quite intensively on the reform of fossil fuel subsidies. For instance, you have been actually working on the methodology for the inclusion of a specific indicator in the context of the SDGs, the indicator 12C1, if I'm not mistaken. So can you tell us a bit about your work, ISD work, in the area, both at the international, but also at the national levels?
Sure. Thank you. Thank you. Well, thank you first for the invitation and being able to be part of this very, very interesting panel and interesting topic. So, at the IISD, basically, the Global Subsidies Initiative of the IISD, we work on supporting the energy transition and mostly identifying or understanding what is the role of fossil fuel subsidy reform in that transition. So, yeah, we have a strong focus on both advocating for fossil fuel subsidy reform, producing research, but also analyzing fossil fuel subsidies and looking more in depth at what they are, the different typologies, which countries are subsidizing what, etc. So that's, let's say, part continuation, part same work as what Luisa was partially talking about before on the work of OECD on fossil fuel subsidies. And today what I wanted to talk about a little bit more is so it's focused on the subsidies part of the tax expenditures. So really understanding how big are tax expenditures as part of all the fossil fuel subsidies that are estimated so far. And as you were mentioning, Agustin, also the how that links with the SDG, so with the Sustainable Development Goals and the SDG 12.3.1. So it's complicated, so I will be telling also a little bit more about that. And to do that, I have a presentation, so I'm going to start sharing my screen. Okay, so that should be working now. So first I just wanted to bring the numbers into perspective. So we all know that fossil fuel subsidies are very big, and as Agustin was mentioning in the beginning, we all know as well all the negative aspects of this harbor. And there are many governments, several international organizations as well, and the international community has been pledging and advocating for reform, also committing to reform, but still the numbers are big, and that's what I wanted to show here. So the latest estimates provided by the OECD and the IEA, so the joint inventory, is from 2019, and for the consumption subsidies, they estimate $416 billion of US dollar. That covers 77 economies and looks also at the fossil fuel-based electricity. So there are many ways to classify fossil fuel subsidies. One of them, and the most relevant for today's topic, is in terms of their typology. So it's what kind of in which form the subsidies are being given. And today we have three main typologies which are being estimated by international organizations. Those are the budgetary transfers. It's basically when the government just gives transfers money directly to the fossil fuel industry, or related. Induced transfers is what there is the price of fossil fuel subsidies is defined below what they should be their cost, and here I'm simplifying a lot on the definition, right? And then the tax expenditures, as Luisa was saying, also the foregone revenue. Those all respond to the definition of subsidy that is given by the WTO, which is actually the one that most commonly accepted for subsidies in general, but also for fossil fuel subsidies. And there's a fourth category that I will get back to later, but today we don't have estimates, or at least international estimates for that. So just a couple of notes on that. So we know that the fossil fuel subsidies vary strongly with fuel prices. That's why we see there was a peak overall in around 2012 when oil prices were higher, and then it went down accordingly. And then also an important thing is the importance of tax expenditures within the total amount of fossil fuel subsidies. So we can see here that over the past 10 years, more or less, it represented between a third and even half of the estimated value of fossil fuel subsidies. So to dig a little bit more into tax expenditures and the part of consumption subsidies, I looked, I took the numbers from the OECD database. basically, and we see that, yeah, I wanted to look at that through by fuel type, and we see that more than 80% of the total subsidies in the form of tax expenditures for consumption, they go actually to petroleum products. So that's a bit what Luisa was mentioning before about the tax differentials between the different transport fuels and many other exceptions that are related to that. So just looking at that, and again, I want to insist also on the point that Luisa mentioned about how tricky these numbers are, or difficulties to get like these numbers, because as she was mentioning, so they depend a lot on the benchmark used. I mean, they fully depend on that basically. So it's not that we can compare these numbers. However, well, I tried to put them in here, and again, the previous number is just an estimate, is what is currently published, but yeah, we normally say that it's at least that, because yeah, there are many things that well, due to the benchmark, they might not be reported. And again, here, not with intention to compare, but just to showcase more or less what measures are there reported today. We can see, for example, that in Europe, France and Italy are the countries that have the highest say subsidies in the form of tax expenditures when we look at the consumer support estimates. So they are mostly diesel tax exemptions for road transportation, but also other uses. And yeah, and again, we see the diversity of this. Doesn't mean that the other countries don't have, it's just that the way the calculator, they measure that is just different. And to make the link with the Sustainable Development Goals. So as Agustin was saying, so fossil fuel subsidies are part of the SDGs in the form of one of the indicators for SDG 12, so responsible consumption and production. And it's the one, well, this indicator basically measures the amount of fossil fuel subsidies per unit of GDP, looking at both production and consumption subsidies. Countries are encouraged to report on this as of 2020, so last year, and actually UN Environment, who is the custodian of this indicator, is working already this year to produce training materials so that countries can start reporting on this as of this year. Despite the indicator is total amount of subsidies per unit of GDP, actually UN Environment is encouraging countries to have a detailed list of the different measures and even give details, for example, on what is the tax benchmark used to estimate the tax expenditures. So I don't know if this information will be published, but at least countries will be reporting on that. So already when it comes to transparency and accountability, that will be a very good exercise to do. So the methodology looks at 4 categories of subsidies, which include also the tax expenditures, and this is basically what is on here. So we have the direct transfer of funds, is the budgetary transfers that were shown in the beginning, induced transfers, so price support, also we saw that in the beginning, tax expenditures, another revenue foregone, and also included in this category under pricing of goods and services. And the last one is transfer of risk. So depending on the availability of data, of how difficult or easy it is to get these subsidies, and also how accepted they are, let's say, they are in terms of like, you know, considered as subsidy measures. The methodology looks at, well, has basically classified them, and according to this classification, they recommend to report on or they strongly encourage to report on some of them, and they leave it voluntary to report on others. So direct transfer of funds and induced transfer, they are relatively easy, relatively accepted. So you can see they have pluses all over. Tax expenditures becomes more complicated, and mostly because of the, well, we call it complexity, but it's the benchmark, the way they are calculated or estimated. And actually that's why they have left them, or they say that the reporting on them is voluntary. Again, the templates that UN Environment will use to report on this is expected to have this information, but countries are, I mean, it's voluntary for countries to report on those. And then the last category is transfer of risk, which, well, there's very little known actually about this one. Today, there are not known international estimates on that, at least not at the same level as the other subsidies. So this will need a little more time and more capacity built within the people at the statistical offices that are going to be doing the reporting before they can actually start reporting on that. But I just want to get back a little bit more on the tax expenditure category. So it's basically what Luisa was saying in the beginning. So as part of the methodology development, so when the methodology for the indicator was done, there was the team looked at the information available from different countries reporting on tax expenditures. And we saw that basically the good core information was reported by, it's a bit more than almost a third of the countries. Some other countries also, they had some information, but it still wasn't completed. And then almost a half, they did not have any information on tax expenditures. So that's why it's still a bit complicated category, and there's a lot of work to do in terms of analyzing, having a unified benchmark, or at least, identifying ways that this can be easily identified. Basically, that the benchmark can be defined so that the estimates can be calculated. And just briefly to conclude, so summarizing what I was talking about, so tax expenditures are a very important actually part of fossil fuel subsidies. Even if today the estimates is not complete, both in terms of countries and both in terms of measures, then again, the estimates are not easy to get, and there's no comparability. The reporting on tax expenditures, that's also a bit what Luisa was saying, and in general also fossil fuel subsidies, it's important for transparency and accountability, but doesn't mean that the fact that they are reported, it has to be reformed. This is to open a dialogue and understand where the money is going, understand whether this is efficient or not, and whether it's meeting its intended purpose or not. And then, there's need for capacity building and more transparency, especially when it comes to tax expenditures. And that's all I wanted to share in this presentation.
Thanks a lot, Lourdes. Very interesting. Without getting too technical into the indicator, right? I'm really interested about that part personally. And I was a bit disappointed when I knew that the tax measure component of that indicator remained voluntary for countries to report on that. Again, I understand that international comparability can be tricky, but here we are talking about reporting at the national level compared to GDPs at, within those countries. So I'm wondering, and I know that the lead on that one is on UNEP, but I know that the IISD was involved in the process. So I would like to know if you have a few more of the details of the political economy of why it's the case. As part of the civil society, I see the bit as the egg and the chicken, right? We keep complaining of how opaque and not transparent tax expenditure reporting is in many countries. And when we have the possibility to push countries to improve the transparency, we just make it, voluntary, and we lose, in my opinion, an interesting opportunity. And this is even more striking because based on the OECD data, we know that 70%, 77%, or almost 80% of fossil fuel subsidies are granted through the tax system, right? So we are saying that governments should report on fossil fuel subsidies, but 77% of those subsidies are granted as tax expenditures, and that remains voluntary. So do you know the details of this? Is this really a lack of political will, or is it a technical issue? What is it about?
Yeah, to be honest, I was not part of the exercise of developing the methodology, so I don't know the specifics, but I can talk, as I can give my opinion and based on the experience in, from working in different countries. So, I think it's a part of technical, and when we say technical, it's also the way that actually, let's say, the tax expenditures as subsidies are understood. So again, I'm talking here my personal views, about my personal views. So obviously there's very different between countries that are mostly consumers of fossil fuels and those that are mostly producers. Now we're focusing on consumption. So here it's, in the end, this is, I think it gets back to the topic of what is the benchmark, what is the right tax that should be applied. we know even when we travel, you know, how different, even within Europe, no, like the different prices. And yeah, as Luisa was saying, no, okay, sometimes it's very easy just to say, okay, if gasoline costs this and the diesel is that, then this is the gap, the differential, but sometimes not. And also, for example, I mean, many countries still consider that the fuels, especially transportation fuels, but also for heating, etc., they should have preferential tax rates because they are basic needs. But they don't realize that actually, you know, taxes normally they can be, or at least fossil fuel subsidies, they are normally very, very regressive. That means normally the ones that benefit the most are those that consume the most, that normally are the richer people. And I think this is still work to do in order to understand this better and better understand which groups of population are benefiting the most, which ones not. And I think that applies worldwide. Yeah, also, I mean, it depends on the pricing mechanism for fuels. There are many countries, for example, that have these floating pricing mechanisms for diesel or gasoline, etc. That means that sometimes they are taxing, sometimes they're subsidizing. So also, how do you calculate that there? How do they estimate? And for them, they don't, I mean, technically it could be feasible, but again, if they are just using their formula doesn't really consider the concept of tax as a pure tax, you know, it's just like they kind of have this fund, floating price, so that when the prices are lower, international prices are lower, they get money. When it's higher, they reinject back. So it's really the need to understand, and also really there's an effort to do and understanding how the different price mechanisms that are used today for fuel prices all over the world, how they actually fit within the tax, let's say, tax mentality, so that the benchmarks again can be properly defined. And then, yeah, I mean, I know also as part of the SDG methodology, there were interviews with many countries all over the world. And yeah, I mean, again, the perception is not always the same. Not all the countries have for example, the obligation to do documents that reflect this, or sometimes it's harder to get. So that's why also, you know, if it's something, you know, the SDG reporting, the SDG indicator reporting is a unified international effort. So also the idea was to kind of bring everything more or less to the same level for all countries. And actually, the methodology has more detailed information in the last annex. I think they go through different countries that were looked at in detail for these exercises, really to look at which data are available, which information they have, etc., that can support the reporting. And yeah, you can see more in detail which countries, for example, did not have much information that relates to tax expenditures.
Thanks, Luz. And don't take me wrong, right? I mean, even when obligations are out there, and I mentioned the case of the directive in the EU, sometimes countries just decide not to do it and not to, you know, to comply. So it's not only about putting that way, it's just about the process of how we get there and make it more transparent in a sense. So thanks a lot. Let me move to Marco Fantini, who is the chief economist within the VAT unit of the European Commission. So Marco, we are now moving into VAT, the other big topic of today, VAT related expenditures. And this is an interesting area in the EU, because there is a directive that sets the framework for the VAT rates across member states. But also member states have a certain degree of freedom, right, to set the number and level of rates on specific goods and services. So this, again, we come back to this tension that Paul mentioned before between national governments and the supranational institutions. So yeah, there is a permanent tension regarding broadening the tax base and using exemptions to reduce rates to pursue policy goals, social goals, reduce or even technical hurdles, like in the case of financial VAT exemption. So can you please give us an overview from your perspective and experience on the use of VAT related expenditures in the EU? You have to unmute yourself, Marco.
Yes, sorry. So can you hear me now? I have prepared a small presentation to give really a high-level overview of this. Let me see if I can you see it? Can you see my presentation?
Yes, perfect. Maybe you want to make it larger? Yeah.
Yes.
Right, perfect.
So basically, indeed, you're perfectly right. Member states do have quite some leeway, not really about the number of rates. So the number of rates is fixed, but they do have substantial leeway in practice, you know, with regard to the level of rates and also with regard to what goes in the different rates, right? So this is a very complex area. I was thinking in my presentation of focusing just on a few aspects. So one is how extensive is the use of VAT tax expenditures, whether this use then is justified. And then finally, I would like to come to a reform proposal that the European Commission is debating now in the Council, because it is about exactly this topic, about reforming the rate regime. So on the first question, well, the answer is that the use of tax expenditures in VAT is extensive. And, you know, we can distinguish two types of tax expenditures. On the one hand, we have exemptions. And on the other hand, we have an array of reduced rates. Now, technically speaking, you know, you have a variety of reduced rates. So there is the, you know, there are two regular reduced rates, and then there are super reduced rates, and then there are parking rates. So it's really an array of reduced rates. So exemptions, so these are, of course, you know, sales of goods and services that are wholly exempted from VAT. And these are, in principle, quite permanent, and they are mainly linked to public interest, so to a public interest motivation. So, for example, medical care. You don't pay any VAT on your hospital bill. You don't pay VAT on a visit to the doctor, you know, and that is because it's seen to be, you know, in the public interest to avoid taxing, you know, this kind of expenditure. And similarly, you know, the education sector is also exempt from VAT. And that's, you know, it makes up quite a substantial bunch of the theoretical revenue. It's an important exemption. Then there is another exemption, another type of exemption that is mainly or primarily, let us say, linked to technical reasons. So, and typically the difficulty of applying VAT on these transactions, you know, and the prime examples of that are VAT on financial services and VAT on rents. So currently, you know, you don't pay VAT on financial services, and rents, you know, it's a complicated story because the question is also owner-occupier rents, you know, which would be extremely complex to tax, of course. So exemptions is one large bit of the story, and they are, I think, objectively more difficult to address. And then there is another part of the story, is this whole array of reduced rates, which originally were introduced with social objectives, but that in practice, you know, they are prone to politicized debate. And again, then we have another type of rates, which is super reduced and zero rates. And these come from a different issue altogether. So these come from a historical issue. So when the EU decided to harmonize the system and have only a certain number of rates, you know, to avoid the jungle of rates, and to fix certain principles, such as, for example, the standard rate should not go below 15%. Well, this then met the opposition of several member states that had a much wider use of reduced rates. And then as a result, because in the EU, as we all know, all tax directives have to be agreed at unanimity, well, the result was that these member states got derogations. So they got essentially a grandfathering provision that said, okay, you have super reduced rates, you have zero rates, you can keep them. You cannot introduce or more rates, you cannot expand their scope, but you can keep what you have. And then this, created a big problem, that got bigger because it created a lack of equal treatment amongst member states. And in particular, this became evident with the enlargement, because the new member states did not get, of course, the possibility to have all this array of super reduced rates. But after some time, they started demanding it, because reduced rates are popular. And typically, what happens is, we've seen this with temp tax. There is a campaign start saying this particular good should not be taxed or should be taxed less. And then, we found ourselves in the EU in a situation where certain member states could tax less and others couldn't because of these stencil derogations. So this situation then came essentially to a kind of blockage. And that is then the reason why now the Commission has presented a reform proposal, which I'll discuss at the end of my presentation. So overall, if we take all together the rates policy gap, so let us say the shortfall with regards to the theoretical revenue that could be raised, by abolishing the exemptions and by abolishing the reduced rates. So what we see is that the rate policy gap is, almost twice the actionable exemption gap. So to explain what is this actionable exemptions gap, I have said before that some of these exemptions are not easy, or it's not realistic to abolish them. So we have in our VAT gap report, we have a category which is called actionable exemption gap, and this refers to the exemptions that could actually be abolished. And as you see, reduced rates count for almost twice that. So the reduced rate problem in terms of VAT tax expenditures is almost twice as big as the exemption problem. So here I won't go into this table in detail, of course, but you can find it in the VAT gap report, which the European Commission publishes every year. So here you have, as you see, the situation is highly different, amongst member states. We have member states with a very wide recourse to reduced rates and to exemptions. And we have other member states which remain much closer. One example is Denmark, to the ideal VAT system, which would be one standard VAT rate and very few exemptions. So, and this then is a reflection of the political culture of each member state. So we see that there are clearly some member states which I'd say broadly speaking are let us say those in the Anglo-Saxon tradition. So UK, no longer a member state, but Ireland and Malta and Cyprus, that they have a wider recourse to reduced rates. The same can be said for some Southern European countries, like Italy and France. So the reduced rates are, embedded in a certain understanding of the tax system. And they are very popular, at political level. So this makes it a very difficult area for reform. And then, another issue is the complexity that this is breeding, because, we have, although the ideal and the theoretical the treatment that the Commission was originally proposing, as a system, was one standard rate and one or maximum two reduced rates. As you see, because of these stencil provisions, we have member states that have, like, look at Ireland, for example, we have one 4.8% rate, one 9% rate, one 13.5% rate, one 23% rate, and this doesn't count as zero rates. So basically, this, let's say, jungle of rates has remained, and there is virtually no progress towards simplification, and on the contrary, there is over time a tendency for distortions to increase, because since standard rates have tended to go up over time, this has created a wider gap with regard to the level of reduced rates, because since politically it is unpopular to raise the taxation level of reduced rates, because there is this idea that they are socially friendly and so on, then this creates a gap that gets wider and wider, and this then increases the distortion costs of it. So apart from the direct costs in terms of distortion, there's also an impact on tax compliance costs. So the costs that taxpayers face in complying with all VAT rules. And research shows, that having a high number of reduced rates then not only has a substantial budgetary impact, not only creates, distortions, but it also has a substantial impact on compliance costs. Why? Because, inevitably, when you try to define those goods and services that deserve a lower rate, then you have to define them. And in practice, the definition of a good and services inevitably creates some gray areas at the border. So I could tell you, stories, there are many funny stories around, like, for example, the UK, they had a famously complex system. And for example, they had a different VAT rate for biscuits depending on the chocolate content. That's because the UK had this idea, which is still very much ingrained in their political culture, that there is, let us say, there are luxury goods and non-luxury goods. And when this came to biscuits, then they decided that a biscuit with chocolate is a luxury biscuit, and a biscuit without chocolate is then a simple foodstuff that should be taxed less. And so, there's a whole set of rules about, what is the admissible chocolate content, before a biscuit becomes, a luxury biscuit. So you have all this complexity, and when you have complexity, of course, you also have legal uncertainty. And VAT is a complicated tax, and all this makes it even more complicated. So then the question, this raises the question, is all this use of reduced rates, justified on the basis of social grounds? Or, well, it depends a little bit who you ask, because most VAT economists, are somewhat skeptical of, using reduced rates, and they favor, broad, simple VAT system with, really most goods being taxed at a simple standard rate, and very rare exceptions, if at all. And this is also what the Commission has always recommended. The Commission has been for decades recommending member states to broaden the base and reduce the rates. But then on the other hand, if you look at the political dynamic, and we have here Paul Tang, who can maybe give us some indication of that, at the political level, reduced rates and granting reduced rates to certain goods, even remains very, very popular. And historically, it was also introduced out of equity concerns. And although the latest thinking amongst economists is that the case for using VAT as a redistributive tool is not very strong, it remains politically a very popular argument, and one which is difficult to challenge in the political discussion. So we keep seeing a lot of support, not only for maintaining these tax expenditures, because that's what they are, but even for expanding them to new goods, that become popular. And so we economists, we have doubts because, particularly for very specific goods, we suspect, and there's evidence for that, that if you grant a reduced rate on a very specific good, producers then tend to pocket, a big part of this tax cut without passing it through to customers. Then we also, see that once a reduced rate is granted, it's almost impossible to take it back. So there are all sorts of difficulties. Of course, we also face the difficulty that everything at EU level, in the tax domain has to be decided at unanimity. So, so then we come, to the discussion at the EU level. So basically, our policy framework, I'm simplifying it, of course, very much. But our policy framework is that fundamentally, reduced rates are only applicable to a fixed list of goods and services, which is decided at EU level. So a member state cannot wake up and say, I would like a reduced rate on gold watches because they are typical in my culture, right? So this would not be possible. So the EU policy framework is that the reduced rates are only applicable to so-called Annex 3 goods. So, and then Annex 3, contains, the classic goods, where you would expect, some kind of social protection like books or medical equipment for the disabled and so on, right? Medicines. But then again, we have these grandfathering provisions. So as a result, we have member states are free to raise rates, but typically we see at European level, the discussion is not about raising rates. It is about extending a reduced rate to a new good that is not on the list. And then what happens is typically you have a member state that, or several member states that come and say, we would like to put a reduced rate on good X because of reason Y. And, as you can imagine, this happens frequently because there's always some good reason, for reducing rates on something, but then typically member states which tax that same good, the other member states, let us say those from which the demand did not originate, they are typically resisting this proposal because they are afraid that if they grant this possibility in the EU directive, then they will face lobbying pressure at home to change their own VAT system and to grant this reduced rate treatment to their own member state. And so the reflex, understandably, of the ministers of finance is, no, if it's not coming from us, we are against. And so this, typically results in in deadlock and very, very complex discussions where at member state, at council level. So the Commission has made a reform proposal, which is currently discussed in the Council to overcome all this. And the proposed reform is quite bold, because then the idea was a change of philosophy from positive to negative list, meaning that currently we have a positive list of goods to which you can apply a reduced rate. And if the good is not on the list, you cannot. And this is what then creates all this discussion. And we in the Commission, we thought, okay, to get out of this deadlock, let's change the philosophy. We say, okay, let us instead define a type of goods and services on which there should never be a reduced rate, because there's no reason for that. And then all the rest, we leave it to member states. You want to grant a reduced rate there, go ahead. And this then would amount to a liberalization, and also the proposal contained the idea of granting all member states the same treatment, and so granting them all two rates, between two reduced rates, two normal reduced rates, then one additional rate between 0 and the reduced rate, and 1 0 rate. So what would that mean? This would mean that every member state has the same rights. You don't have member states with more favorable treatment, like Ireland and Poland then cannot have a reduced rate on say, children's nappies. So the idea here was really to have equal treatment for everyone. Now, the proposal is being discussed in the Council, and not surprisingly, there is some opposition, because, as I said before, you always have some opposition in this domain. Those member states that tax more don't want to have the possibility of taxing less, and those that are already taxing less, and maybe sometimes even on doubtful grounds, they don't want to have the trouble of increasing the rate on that particular good. So difficult discussion, but it is being discussed right now. So we'll see how it plays out. Then we also, the last thing I would like to mention is that, there's an objection, of course, to giving this, to liberalizing the regime. It is that, what about if member states start granting too much of these reduced rates? Could it erode revenue, and would it go then in the wrong direction? And that's why the proposal, the Commission proposal, also contains a so-called macroeconomic safeguard clause, which is a revenue clause to prevent, let us say, revenue erosion. So this would be it. So to conclude, we have a very, and maybe to give a quick summary, we have a complex situation in Europe. It is difficult to reform, characterized by many rate bands, and characterized by constant discussions on the content of these specific goods that are eligible for reduced rate treatment. We also face, a lack of equal treatment. There is a proposal on the table. The proposal, I think the main proposal is not to reduce the use of, tax expenditures. the main objective is to create an equal treatment for all member states. We think that, however, our recommendation to keep, a broad, to limit the use of tax expenditure as much as possible remains. And we hope that member states will move towards that model in the coming years. So I would stop here.
Yeah, and let me take you one step further into a concrete good or services in this case related to VAT, and is what has already been mentioned before, the VAT treatment for financial and insurance services, right, which is currently exempted in the EU, is something that is also being discussed. So what is, if you can summarize the Commission's intentions on this issue. I know it's big. I honestly tried to get the figures on what's the fiscal cost of this exemption for the EU as a whole, and I couldn't. I found a few figures for specific countries, like 9 billion for the UK, for instance, before Brexit. But maybe you have an order of magnitude of the cost of the whole thing.
Yes, the order of magnitude is about 60 billion. That's the order of magnitude that we believe is roughly 60 billion. So it's a substantial amount. Now, as I was saying in my presentation, this VAT on financial services are now almost entirely exempt. Actually, there are some banks pay some VAT, but very little on things such as, for example, if you have a deposit box at a bank, where you keep jewels, for example, well, that, in some member states, you have VAT on that. But let us say the classic financial service, well, that's exempt. And the question is that this creates, has a number of consequences. The obvious one is the budgetary cost. But there are also less obvious ones, which are the fact that this creates an important distortion in the system, because it is one important principle of taxation that when you tax inputs, you must not tax some inputs more than other inputs. That's a fundamental principle of taxation. There should not be differential taxation of inputs. And ideally, there shouldn't be taxation of inputs at all, okay? Now, the exemption system, it's complicated to explain, but the exemption system results, in fact, in precisely that. So some inputs are taxed, unintentionally taxed. So we have another problem, which was triggered now recently by European Court of Justice decision. So we have a provision in the VAT directive, which was used in many member states to reduce the impact of this distortion I was telling you about. And these are the so-called cost-sharing arrangements. Now, these arrangements were not a perfect solution, but they were, used as a way to mitigate the problem. Now, there was recently a decision, a judgment by the European Court of Justice that said this instrument is not applicable for the financial sector. So it was banned. And then, of course, this created the question, if it's banned, then what shall we do with this? We have to find some kind of solution. Shall we reinstate it in some way or another? Or shall we find a more global solution to the problem? So basically, we're looking at exactly that. We are still in the reflection stage. We're looking at various technical options. So the question is really, we're conducting, this is not going to be, a very limited review. We're really looking at the whole scope of the whole range of solutions on the question of what is the scope of VAT that should be applied to financial services, ranging from 0 to total. We're looking at all of that as an academic matter, as a matter of study. And we're looking at this, and proposals will come. proposals will come. So it's an important reform, because until now, because of the difficulty of taxing interest, you know, the financial sector has always been exempted, you know, entirely, and irrespective of these problems I mentioned. So it is an important initiative.
Thanks, Marco. Maybe Paul, you mentioned in your intervention the forthcoming move in this direction. Do you want to jump in and complement what Marco just said, maybe from a personal perspective, or even if the Parliament has started already to work on this as well?
Well, generally, the VAT is part of the discussion in the European Parliament, and takes a keen interest from the European Parliament. And there will be no exception, of course, in the FISC committee, where part of our work will also be looking at, under the heading of the sustainability of the tax system, a more broader discussion on, and the sustainability is defined broadly. It's not just environmental, it's also social and economically. And I very much hope that we take on also the discussion on, and I expect to, we take on the discussion of tax expenditures in general, including the VAT. I think the VAT for financial services as an interest after, I know after the financial crisis, there were in several member states initiatives to tax a bit more. Because some of the services, I know that the interest margin on banks is difficult to tax for technical reasons, but there are many services that are now exempt that that could be very well taxed. And at this stage, I see very unequal treatment in a sector which is sometimes highly mobile, because I also remember that asset management has moved around Europe after a differential in VAT. I think part of it moved now to Luxembourg because of unclarities on the VAT level. So this is, I think, one of the important topics. I was fascinated by the presentations, by the way, where you see that. So I also see the question in the chat: why do we need to have this sometimes at European level? And I think one is very clear: if there are spillovers, environmental reasons, climate change, that's very clear. It could also be very well be that you have for competitiveness of the sort of race to the bottom type of argument, where you would like to have, and I just mentioned the asset management as an example. But it's also, because this is also from the presentation from Marco, it's also European regulation can be a commitment device, right, for national parliament. There's so many people pushing in national parliament. Well, you should reduce the rate for hairdressers. You should, because this is low-skilled jobs that we should protect. So there are many. The first thing that people go for is sometimes VAT, or at least the consumption tax, because they are very much on the mind of people. So the political pressure for changing this, so liberalizing the system, I think, is exactly what your discussion that you should have at the European level. Where do we want to have degrees of freedom and where not? Because you don't want to have too much degrees of freedom. Having said that, I have an economist's background, so I have very much deep sympathy for the idea that you should have a broad tax base, that you should have no differences across sectors, that you should have not have to reduce the differences, for example, in the VAT of reduced and standard rates. At the same time, I very much understand the position of politicians at the same time. So my friends and colleagues from the field of economics try to make an argument for one standard rate in the VAT, and I say, well, how do you want to sell the story? You want to raise the price of food, so it's going to be on olive oil, on milk, on bread, or whatever. Tell me how I'm going to explain this. And this is the general thing. So when you talk about tax expenditure, yes, there is a political lobbying, but that's part of our democracy. But if you want to change the situation, it's not just the transparency that we need. Does it arrive at, does they have this tax expenditure have the effect that we want to have? But also, like I said, we want to have a broader discussion how to make sure that we have the distribution effect that comes along with it. You need a broader package. So that's the only way I can see this type of change. We need to have a reform package which includes very clearly the distributional effects, because that calls for energy taxes, this goes for VAT. If you want to make the tax, like I said, simplification of the tax system is not simple, but this is part of the resistance we have to overcome, is to make sure that the distributional effects are the way we want them to be. And we don't hit by accident or not by accident those people that are in a poor position already, because that will only lead to so much political resistance.
No, I totally agree. And what I find fascinating, actually, in both areas, in the fossil fuel subsidies and then the VAT discussion related to tax expenditures, is the use of the distributive impact of some of these provisions. And this, again, tension between the political argument versus the economic argument, right? And I understand that politicians have, as you just said, interest that, you know, they have to be accountable with the society, and they might have the interest of specific groups at certain points. The current situation is a case in point, right? They need to deal with this, and in some cases, actually, they have been implementing VAT reduced rates, ad hoc policies going in this direction. What I find fascinating is sometimes the misuse of the same argument. And let me give you a concrete example. VAT reduced rates for foodstuff are often sold as a policy that clearly target the poor and poor households, those in need. And it's not necessarily the case, right? Because most of the benefits accrue to the rich, because those are the households consuming the most. So it's a problem of the same discussion, the same argument, but just the way you present it can be used for one or the other direction. And that's very interesting. That also applies to fossil fuel subsidies in a sense. I will come back to that in a sense, but totally agree with you. So, and let me use this to bridge again to the fossil fuel subsidy discussion. Luisa, you want to comment? Sorry, go ahead.
Sorry, maybe it relates to what you just wanted to say, so please go ahead. Because I just wanted to make a point on the distributional effects of
exactly. Yeah, I was using that to pass the ball again to you, and that's part of why we decided to merge both topics in one event. Also, the distributive impact of fossil fuel subsidies is part of the discussion, this political versus economic argument tension. So yeah, go ahead, Luisa. You know much more than me on this.
I mean,
oh,
you muted me, so now it works. So yeah, of course, there's the discussion about carbon pricing and the distributional effects of energy taxes and the distributional effects of energy tax expenditures as well. I think, and the crisis, I mean, during the pandemic, then the resulting crisis that has disproportionately affected these vulnerable households. I mean, these concerns are over potential price increases are like they merit a particular attention. So maybe it's really an important topic. But what we should not forget, at least in the energy tax, like I just speak on the energy tax and carbon pricing, there is a way to cushion the regressive effects of carbon pricing, and preferably this would happen by not reducing the decarbonization incentive. So not giving reduced rates to households, or not giving them a check to go and fill up the car with diesel at the pump. No, keep the preferable solution would be to keep the carbon price in place, and then general direct transfers to these households through the social benefit system, direct transfer through the tax system. These are ways where you can cushion the regressive impact and still keep the carbon price signal and the decarbonization incentive in place. And so I think that's what I want to say. Yeah.
May I add to this that you also need to think about the sequencing of reforms. I think it's also for the popular support of these measures, it helps a great deal if you start with big polluters. So for many households, the change going to, let's say, a carbon neutral household is pretty big. And at the same time, the big polluters are still exempted from the trading emission system, have reduced rate in energy taxes, like at least is the case in the Netherlands. So if we still have the steel industry emitting at a high pace, if we still fly every day from after the pandemic, fly every day to every holiday resort. and at the same time, you want to raise, let's say, the price of diesel. Well, that's an odd combination, right? So I think also what we need to think about is the sequence. If you want to have reforms, that's also important. You start with those who can contribute most.
Yes, and exactly the perceptions. We have seen this here in Paris with the Yellow Vest movement. It's also a perception of, I mean, this carbon price trajectory that the French government has laid out existed before, but then petrol prices increased as well, and you need to manage perceptions and communicate and the sequence. And yes, as you say, it's super important. I agree.
And coming to your point, Paul, on the diesel taxation. So we know that that's an issue within Europe. There are big differences across borders, in some cases, like border countries, on how they tax gasoline and diesel. And I think the largest is the border between France and Luxembourg, where French charge around 0.60 cents of euro per liter of diesel, and Luxembourg like half of it, 0.35. So do you think that the energy tax directive and how it will be changed will be the effective instrument to deal with these issues, or do you think this is like a deeper discussion?
Well, it can certainly help, right? The Energy Tax Directive is due for an update, since we haven't seen the indexing of the rates, so but that means that it should raise the instrument is to raise the minimum, and that's certainly helpful, but it's not going to change, I'm afraid, the basic situation that you have differences in, let's say, in excise duties, and that countries will try to create those differences. For example, as long as I know Luxembourg, they have lower excise duties on petrol, alcohol, and cigarettes. That's part of their business model, has always been. I'm not sure that will change a lot, but you can at least alleviate the problem a bit, and that's why we need a review of the Energy Tax Directive.
Okay, Lourdes, I know that you have worked on fossil fuel subsidy reform in specific countries, not necessarily European countries, but maybe you can tell us a bit about countries where you have seen successful reforms that can probably be used by European countries to get there. So maybe you can just give us a bit of an overview of which are the main variables, the timing, you mentioned in your presentation the price of oil, international price of oil that's linked to the successful reform. So these things that governments should need to take into consideration.
Yeah, thanks for the question. Actually, I wanted to raise my hand as the question about political economy came. I just didn't know where to find the button. So great, thanks for asking about it. I mean,
it's a wave, like physically. The
physical way. Okay. No, so I mean, yeah, I mean, I think that links a bit to the previous question about the previous point about the political economy side. I mean, there are examples of countries that have reformed fossil fuel subsidies, especially consumption, like diesel, fuel, I mean, like gasoline prices, etc., and also that have taxed. That's even more recently, I mean, after the COVID-19 crisis, more concretely, there are two, India and Costa Rica, that are implementing an additional tax on fuels, so transportation fuels, in order to collect funds to support the recovery. And actually, I think the case of India is very interesting, because obviously that was not a popular, I mean, normally taxes, no one will think that increasing taxes in times of COVID doesn't sound like a very even reasonable proposal or measure. But one thing they did first, they did it when oil prices went down. And that's what most countries actually that have implemented reforms have done. Normally they implement it when oil prices are down. And the challenge there is actually how to avoid backsliding. So that means once prices go up, how to avoid that the subsidy reform stays, so that the price keeps on evolving with the market. And again, India is an example. So they maintain that, and not only maintain that, they increase that, and some regions within India, they even implemented additional tax. So fuel prices started increasing. There were protests. There were comments from especially truck drivers and so on. So, but actually, the government, Moody's government, has been very let's say, I mean, politically, he has handled that, I think, quite wisely. So today or yesterday, there were also news again that, well, he had been exposed publicly to talk about this, why prices keep on increasing. And basically, he was just blaming the opposition, saying that the problem of India actually is that they keep on importing too much fuel, and that fuel dependency, the dependency on import fuel should decrease. So really, he turned that upside down. I mean, that's a very, very particular case, and that's just, I mean, it came to my mind also because that was 2 days ago, no, or yesterday even, the latest. Yeah, concern about that. But I mean, overall, and it was also mentioned before, the yellow vest. I mean, I've worked in several countries, like defining communications campaigns with governments to support fossil fuel subsidy reform. And actually that has involved a very heavy work on political economy. So really talking to the population, what, why they're concerned, etc. And actually what is very striking is mostly developing countries, I have to say, but is that actually the reform is just a trigger for something else. So it's not that the population revolts because the prices are going up. I mean, yes, there is a trigger, it's an important trigger, but actually it's more like accumulated discontent for many different other policies. And this is the easiest because it's very visible. You see immediately, you go to put fuel in your car and you pay more, 30% more, 20% more, whatever. So that's just a trigger. And I mean, countries, what they have done as well, for example, in Indonesia, when they reformed the prices, the fossil fuel subsidies in 2015, what they did is invest heavily in other social protection programs. It's not even cash transfers, it's just like, you know, what do you want instead? And that's an exercise, actually. I mean, that's not that there's the magic golden bullet that works for all. No, it's something that is very local and it has to be understood locally and the efforts has to be done. And then also another, I think, interesting thing for developed countries mostly is like to play with energy efficiency. So give incentives to consume less so that the prices go up, but your bill doesn't move, play with the bill. And in Mexico, we started looking at that as well. And I mean, it has to be carefully designed, but there's potential there. So yeah, I think those are kind of the things that successful countries that have successfully reformed fossil fuel subsidies have gone through.
Thanks, Lourdes. Yeah, so there are also obviously the incentives to change behavior on like to incentivize to green the economy. Let's put it like that, right? And usually my concern, those ones, although I think most of us agree that green economy is a worth pursuing goal and tax incentives are a valid instrument, you know, it's again the distributive impact, right? We don't, governments should not lose or should keep in mind that very likely the benefits of those tax incentives for green the economy are captured by the very rich. And there's evidence out there. I think that there's a paper showing that in the US, the electric vehicle tax credit, 90% of the benefits go to the top 10 income earners. So I mean, I'm very fine with such a policy if it's effective in green the economy, but the distributive impact should also be considered when designing, right? And these are the type of questions that for me are very interesting, and with this interconnection between distributional impact, green the economy, and environmental effect. Yes, Lourdes, you know.
Just a very quick comment on that. So I fully agree, but it's true that sometimes also there's the scale of the impacts. No? So it's looks like, I mean, sometimes it's the ones that consume the most are the most affected, but sometimes they offer services that then the ones that consume the least because they don't have alternatives, for example, they're also going to suffer. That's a very classical of fuel subsidy or like fuel like price increases in developing countries, sorry. So there's also the need to think on, you know, very broadly on the distributional impacts, recognizing also the alternatives and the effects on the whole supply chain or like value chain of, you know, linked to that.
Sure. So I have a question from Christian von Handenbank. This is something that we came across while working on our database, the Global Tax Expenditure Database. So Marco, this is for you. Are reduced VAT rates always considered tax expenditures? And Christian is asking this because we have realized that the Germans, so Germany, considers some reduced rates as, for instance, for foodstuff, as part of the benchmark system. And hence, they are not reported or included in their tax expenditure report. So what's your view on this?
Well, look, I'm not sure I understand the question. You know, we, as far as VAT is concerned, you know, we, you know, from an administrative viewpoint, you know, we have reduced rates and standard rates, right? And then the question is, you know, are these tax expenditures? I think they are, and they should be considered as a tax expenditure. You know, whatever is not taxed as a tax rate should be. So,
Christian, sorry, I cut you off. Christian, maybe you want to kick in and clarify the German case that you know better than I do.
Yeah, it's for us, it's a tricky issue because when we collect data, when we gather data on tax expenditures and tax expenditures reporting, I mean, Paul has made the argument, and I think it's very convincing, that beyond economic classification, this is a political issue, and you want to have transparency on the real costs and probably also benefits tax expenditure bring to societies. And if governments say that certain provisions that we here in this virtual room would probably consider tax expenditures are considered part of the benchmark system, they don't report on revenue foregone. For instance, as far as I'm aware, Germany does not report, at least not in its subsidy report, on revenue foregone from reduced VAT rates on foodstuff, for instance. So they say it's part of our benchmark system, and this precludes to a certain extent a fruitful discussion at the level of national societies on what kind of tax expenditures do we want.
Yes, look, in fact, you know, I'm not really surprised. You know, Germany, you know, in many cases, you know, we are surprised, you know, at let us say the fact that certain data are not available for Germany. Now, specifically on VAT, you know, we also what we do at European level is we have this VAT gap report, and that is public. But you know, we try with this instrument, you know, to create more transparency. And there you do find a lot of data, and you find data for every country. So that is what we can do. But you know, then of course we don't have the legal power, you know, to force member states to publish this sort of data, you know, which you're referring to. So, you know, the answer is, you know, have a look at the VAT gap report, because you'll find something interesting there.
Thanks a lot, Marco. Yes, Luisa, please.
Sorry, okay, just to add, because we hear this often in our tax incentive workshops that we conduct in developing countries. I think it's, again, a whole discussion of the benchmark that I've opened up with diesel and gasoline rates. It's the same here. And I think it is often, and I don't know if it's the case for Germany, it's often equity, like the distribution and concerns is part of this discussion. I mean, they put maybe a reduced rate on food because of an equity reason, because I don't say that I think it's economically valuable argument, but because you think of food being an item that poor households spend a larger proportion of their income on, so they spend larger proportion of their income on food, so you reduce the rate. But then in the end, and there are studies around that show that the rich, again, will typically spend a larger absolute amount on food. So that, again, the reduction in the tax rate is, again, a transfer from money from the poor to the rich, and it doesn't, in the end, help. So actually, if the objective is equity and distributional concerns, then the outcome, it's probably not.
Yeah, totally. And Joe is asking who defines the benchmark tax system, and for us, that's the million-dollar question, right? And for us, working on cross-country comparability in the context of tax expenditures, that's a tricky one. I can tell you what we do in our project in the Global Tax Expenditure Database. We decided to stick to what governments decide. We are not fighting and showing that one benchmark should be decided over other one. In the very concrete example of what Christian just mentioned, we just take what governments report, right? And if the Germans decide not to consider VAT reduced rates for foodstuff as a tax expenditure and has no report on them, we just live with that. Then the follow-up question is, do we agree that that's the way to go? My personal take is that no, I agree with Marco. They should be included and they should be reported. But yeah, that's the approach that we took to respect what governments are deciding in terms of defining benchmark tax systems. Because the next question comes to harmonization of tax bases, right? Which is a very interesting topic, but I think we will need another event for that one, because this one is getting to the end. We have 5 minutes. So I would thank you all, but if you want to very quickly, the 4 speakers close with a few final remarks. We have 5 minutes to go. Yes, Lourdes, you're the first one.
And I just very briefly, I mean, when I insist on the point that just reporting doesn't mean that you have to reform. So I think that stops many countries, and that's scary, especially when it comes to subsidies. So, you know, they're efficient and less efficient, more efficient subsidies, tax expenditures, and some other less. So just, yeah, that should be, I think, clearly stated. That doesn't mean that the fact of reporting means reform. And I think I conclude with that.
Yeah, no, I agree. Ideally, the fact of reporting is a first stage for reforming, because for me, reforming shouldn't be seen as something bad, right? I mean, even governments should be keen on reforming their tax expenditure systems if they find the good way to do. But without data, it's difficult to get there. So I totally agree. I mean, reform is another discussion, but we need the data first to think about that, right? Marco, please, yeah.
No, I just wanted to clarify, you know, I think in the case of VAT, the situation is a bit simpler conceptually, because the idea of the ideal consumption tax is one that has the same rate on everything. And then we have the reduced rates as an exception to that. You see, and that is why I think the situation is more clear-cut, that we can say, you know, that is, you know, a tax expenditure as compared to other taxes, because you don't have the complications, you know, related, for example, to progressivity. You know, it's VAT is not progressive per se by nature. Then, you know, the reduced rates are an attempt to make it progressive, but then it is a tax expenditure. This doesn't necessarily mean it's a wrong tax expenditure. You can have a discussion on that, but you know, it is. I think it should be seen as a tax expenditure.
Thanks a lot, Marco. Luisa, do you want to go?
Yeah, maybe I would say that transparency is good, but I think it should also be, it is important that it doesn't stand in the way. I mean, if I look at the figures that Lourdes showed for France, that this was one of the countries with the highest tax expenditures. And if I look at my tax energy profile for France, it's one of the best countries in terms of having a uniform rate. So it should go hand in hand. And again, I underline that these effective tax rates, looking at them and not only on the tax expenditures that are reported, is really crucial to get the reform kicking in, actually.
Totally. Paul, do you want to close?
Yeah, thank you. Now it's really a joy to have this discussion. But let me be very clear, I'm not pessimistic on the possibility for change. I think the opportunities for change will come because we have the need to make our societies, our economy sustainable. And we need to, let's say, balance the books of the public sector again. And this time it will not be on the revenue, on the expenditure side. So I think there's a lot of opportunities. When we have this discussion 2 years down the road, I think we will see more opportunities than we see now. So in that sense, I'm not pessimistic. I'm rather optimistic on that this will be high on the agenda in the years to come. But having heard this discussion, having taken part in the discussion, also realize there's a strong relation between direct taxation and indirect taxation, between, or more precise, between income taxation and consumption taxation. Because what we see from this discussion, that the distribution effect is important. So the better our direct taxation, our income taxation is, the more leeway we have in direct taxation.
Thanks a lot, Paul. And yeah, let's then finish with this optimistic view, which I want to agree on. And on that very last note, we actually agree that income taxation is crucial. That's why we had an event last week on corporate income taxes, tax expenditures related to corporate income taxation. And we will have one next week on personal income taxation and wealth taxes. So we invite you all to take part of this series of events. Thanks again, particularly to the 4 speakers, but to all of you. And yeah, keep tuned for the next and forthcoming events. Thanks a lot. Take care.
Thank you.
Thank
Bye-bye.
you.
Thank
Bye.
you. Bye-bye.
Bye.